Hello everyone, welcome to Finance with Medson. In this video we are going to look at an interesting topic called the cost of capital. So we have to understand how a company or any corporate firm can determine its overall cost of capital. So in order for us to easily understand, we have to look at the various long-term sources of funding that are available. So in this video we will focus on the major sources of financing, which includes debt, preferred stock, equity. By equity we mean both internal and external. Internal equity applies for retained earnings, and the external equity is applicable for the newly issued shares. And then we have basically three steps involved in finding the average cost of capital, considering these sources of financing mentioned. So the first step that we'll be looking at is finding the individual costs for each source mentioned. Then after that we have to find the proportions of the investment, which others would refer to as weights. Then the last step in our computations will be finding the weighted average cost of capital, which is better abbreviated as WACC or WACC. We shall apply a number of formulas, so just follow closely as we begin our computations. So we proceed with finding the cost of debt, which is one of the components of the long-term sources of funding. So the standard formula that we're going to be using when finding the cost of debt is KD is equals to KI in brackets 1 minus T. So let's break down the components of this formula here. So our KD, it's representing the after-tax cost of debt, and our KI is the before-tax cost of debt. So our T is the tax rate which is applicable. So tax rate, it varies depending on the country and the nature of the company. For example, companies that are listed on the Lusaka Stock Exchange, in our case, they have the tax rate of 33%, and those that are not listed, they are charged at 35%. Another interesting part of this formula is the before tax cost of debt. In other books you will find different names. The commonly used names are the yield to maturity and the before tax cost of debt. So just take note of that. Having mentioned of the formula and all the components involved, we can now look at an example and how we use this formula to find the after-tax cost of debt. So in this example we have this scenario here. We're saying Medson Limited want to expand their operations. To do so, they will need to borrow $5,000 at the rate of 10%. The tax rate stands at 35%. Then we've been asked to calculate the cost of this borrowing. So the borrowing involved here can be simply referred to as debt. Any borrowing in this scenario will refer to it as debt. So applying this formula, we can easily find the cost of this borrowing, where we say cost of debt is equals to KI 1 minus T. So let's examine the components of this formula from this example here. So our KI in this example, which is the before tax cost of debt, is a 10% return, and our tax rate, which stands at 35%. Then these are the most important items that we use in computing the cost of debt. Then we just replace them in the formula to find the cost of debt, which is equals to our KI, which is 10%, and then 1 minus our tax rate, which is 35%, so 0.35, giving us KD is equals to 10%. This is going to be 0.65. Then multiplying that, we get 6.5%. So this is just a simple illustration of how we apply this formula in finding the cost of debt. However, we will encounter some challenging questions which will require to apply this concept here. So we'll try to break down each component, and then thereafter we apply a typical examination question. Hope it's making sense. Okay, so the second source of long-term funding that we'll be looking at in this video is preferred stock. So preferred stock, here we have also to estimate the cost. But how do we do that? So an interesting feature of preferred stock is that it has a fixed dividend, and that entails that the dividend which was paid previously will just be the same as the dividend that will be paid in the expected time. And also preferred stock, usually they've got some features which falls on both debt and equity. So in order to estimate the cost of preferred stock, we will use this standard formula here, which is KP representing the cost of preferred stock, which is equals to the dividend over the current price of the preferred stock. So in this case, our dividend has been given to be $5, then we just divide by its current price, which is 50, giving us when we punch in, that will be 5 divided by 50, okay, giving us 0.1, which is the same as 10%. So you will realize that taxation is not applicable on preferred stock. Reason being, the dividends are paid after the adjustment of taxation in the income statement. Hence, the dividends come already with an adjustment of taxation. So, application of taxation on the dividend of preferred stock would simply result into the double taxation, which violates the international accounting standards. So, you may have different scenarios, but the idea is the computation of preferred stock cost is simply the dividend over the price. However, in some instances, when preferred stocks are issued for the first time, usually there is a charge which we refer to as the flotation cost. So flotation cost in this case will refer to all the costs involved in bringing the stock on the market. So these would include contacting the stockbrokers, the brokerage fees, some other costs such as listing, getting the permission from the stock and exchange commission, and some other expenses. All those have to be factored in the price in an event when these stocks are issued for the first time, which will be the next scenario in our illustration. So another scenario that we can have under preferred stock is when the flotation costs are involved. Like I was saying, these are simply the costs that are associated with bringing the stock on the market, such as the costs dealing with the registration of the issues and getting authorization from the authorities, engaging the stockbrokers, and other related costs. So the formula remains the same. However, we have to make some adjustments to the formula. So instead of us having the formula as the D over PO, so the price that we will receive factoring the flotation cost has to also change. So in an event where the price hasn't been given after the flotation cost, maybe just a percentage was given, then we have to make some adjustment to this formula. We have to factor in the flotation cost. In that case, our formula becomes KP is equals to D over PO, then 1 minus flotation percentage. So this formula is only applicable when the flotation has been given in percentage form. For example, instead of us having the price after flotation, there was 10% flotation cost, then it will be 1 minus 0.1 here in this formula. So dividend remains the same and the price remains the same. The only thing that changes is when the flotation cost had been involved. So in this second scenario here, we refer to the previous example where the initial price before flotation was $50, and now after the flotation we've been given to be $45, and everything remains the same, the dividend of 5 kwacha. Then we've been told to find the price, the cost rather. So the cost of this preferred stock will be the same dividend 5 over, but instead of us using the 50 now, we have to use the 45 because this is the amount that we receive considering the flotation cost. So it will be 5 over 45. Then if we do some divisions here, what we get is 11.1%. 11.1%. So you realize that flotation costs, they have a tendency of increasing the cost because they are the adjusted costs themselves. They also attribute to the initial cost. So without the flotation costs, in the previous illustration we saw that the cost of issuing these shares direct, ignoring the flotation cost, stood at 10%, and then when we factor in the flotation cost, the cost has risen to 11.1%. so that's the difference there, but the formula remains the same. We just have to make adjustment to the price. So the next illustration, we have to look at how to compute the cost of equity, that's both internal equity and external equity. So follow me closely as we go to that area. So we continue with estimating the cost of internal common equity. So basically we use the same formulas when computing the cost of internal and external equity. However, the only difference is where there is an issue of flotation cost. So remember, internal equity refers to the undistributed profits. Therefore, the price cannot be adjusted for flotation cost because there is no new issue involved elsewhere. So that's the only difference. Otherwise, we use the same formulas. In both the internal and external equity, we use two major broadly accepted formulas in finance. The first one being the dividend growth model, which we'll begin with, and then later on we'll look at the capital asset pricing model. you cannot use both formulas to solve one question. It depends on the kind of information that the question has. So if the question requires you to use the dividend growth model, then you apply that. But if the question requires you to use the capital asset pricing model, then you apply that. Now, the standard formula for dividend growth model is the cost of common stock, which could be internal and external, is equals to the D1 over PO plus the growth rate. So where our D1 in this case is the expected dividend. Expected in the sense that unlike the preferred stock where the dividend is fixed, for the common stock, dividend is subjected to fluctuations depending on the performance of the company. So if enough profits or revenues were made in a particular business year, you expect the dividends to increase depending on the policy of the company and vice versa. So our PO is the current price, which could be the market price, and then the G is the growth rate projection of the dividends, and our KCS in this formula is the cost of common stock. So having known that, the most tricky part is the D1, how to find it, because in most cases you'll be given some terms such as current dividend, previous dividend. So long as you hear current dividend and previous dividend, just know that that's not your D1. Our D1 in this is strictly to the expected dividend. Where you have the current of the previous dividend, then you have to find the expected dividend. So we will break down all these components using various examples before we can deal with the fully comprehensive question. So the example that we have here is saying that Medson Limited currently have a supposed to be have a market price of $60 per share of common stock. The company paid a dividend of $5 per share in the previous year, and the company estimates the continued growth rate of 10% for the next foreseeable future. Estimate the cost of common stock. So having this information, then we have to gather some data here for us to work out such a problem. So the first thing that we come across in this scenario is the market price. Okay, so the market price in the formula that we have there is denoted by PO, which is $60. And then the second thing that we come across in this is paid. So this is the past tense, meaning that it's not our D1, but it's the previous dividend. So our previous dividend is denoted by D0, is given to be $5. And then the other thing that we have here is the growth rate. So this growth rate is a constant one, meaning it's the same one which we have estimated in the foreseeable future. So our G is given to be 10%. So having this in mind, then we have to apply this formula to find the cost of the common stock. So in this case, the cost of common stock, we have to just write down the formula, then we just insert in the variables. So our formula is the cost of common stock is equals to D1, which is the expected dividend, over the PO plus the growth rate. So in other books, this term here, D1 over PO, they also refer to it as the dividend yield. So don't be confused when you come across a term dividend yield, meaning that they've already divided for you. And then this growth here, in other text you find it to be what they call capital gains. Capital gain. So they are just one and the same things. So having known this formula here, then you have to ask yourself, do we have the expected dividend? Of course we don't have. So there is just a simple trick of how to find the expected dividend, which is D1. So D1, we apply a basic formula here, which is the current dividend D0, we multiply with the 1 plus the growth rate. So our D0 in this case was 5, then 1 plus our growth rate has been estimated to be 10%, which is 0.1. Then when we multiply 5, this adding gives us 1.1. Then the multiplication of this gives us 1.1 times 5, which is 5.5. So our D1 is 5.5. Then after we find our D1, then now we can go back to our formula here. Then we just have to put all these variables in the formula, then that we find the cost of common stock. So continuing with the variables, so after we estimated our expected dividend, then we can now apply the constant growth model formula, or the dividend growth formula, which is PO is equals to, sorry for that, which is cost of common stock is equals to D1 over PO plus the growth rate. So this gives us 5.5 over 60 plus the growth rate, which is 10%, which we will just use 0.1 after dividing by 100. Then what we get after some computation here, we have, so the dividend yield, which is this part here, when we divide, it's giving us 0.092. Then we add 0.1. So we are getting 0.192, which is 19.2%. So this is the overall total cost of common stock. So in this case, we are looking at the internal equity. Another interesting point that we have to note when computing the cost of internal equity is that why we have the same formulas, and the only difference comes in when we have some flotation costs, is that for internal equity, you realize that the opportunity cost of holding on to the undistributed profit is just the same as the opportunity cost that investors would get if they are paid in dividends. So if they are not paid dividends, meaning that there is an opportunity cost which is just the same as the gain that they would get if they are given dividends, but it's inversely. So we just apply the same formula. That's the rationale behind that formula. So the second interesting formula or method that we apply when finding the cost of common stock, whether internal and external, is what we refer to as the capital asset pricing model. So in this model is mainly applicable when we are dealing with what we call the market risk, or the systematic risk, which is measured by the beta factor, or the beta factor you may call it. So according to this model, the cost of common stock is given to be the sum of the risk-free rate plus the beta factor, then in brackets RM minus RF. So our RF is the risk-free rate, and then our BI, which is the beta factor, and then our RM is the return on the market. Then we just have to be very careful with this term in brackets here. So this RM and RF, in other texts they call it the market premium. It's simply the compensation that investors would want for assuming a particular level of market risk. So the higher the beta, the higher the compensation, and hence the higher the cost. So that's the relationship which is there. Then having said that, I'll go back to that point which I mentioned, saying that you cannot use the two approaches when finding the cost of common stock, whether internal or external. It depends with the information that you have in a particular question, it will guide you to which formula to apply. That being said, then we'll look at an example which involves the capital asset pricing model. So a good example of the capital asset pricing model is here. So in this scenario, we have this question which says if the return on the treasury bills is 7% and the company beta is 1.5, experts estimate that the risk premium of 10%, then estimate the cost of common stock. So when you have this information, it should be coming in your mind that the approach that you have to use is the capital asset pricing model. So you need to know this formula by heart, which is the cost of common stock using the capital asset pricing model is given to be the sum of the risk-free plus the beta factor. Then we have return on the market minus risk-free rate. So this term here, expected return on the market minus risk-free rate, is what I've been emphasizing on, that in most cases it won't be given individually. They would refer to it as the risk premium. So whenever you hear the risk premium, meaning that our RM and RF has already been subtracted. So we just don't have to go back and start questioning, where is the RM and this and that. No. So our RF, according to the question, is the return on the treasury bill. Why are we using the return on the treasury bill? The rationale behind this is any government security has zero risk. They are backed by the national government or the central government, meaning that the risk attached to that security is zero. So 7% represent our RF plus the beta factor has been given to be 1.5, and then the risk premium has already been calculated is 10. Okay, so the simple computations here so I have 7% plus 15%, okay, which is giving me 22%. So that's an illustration of how we find the cost of common equity using the capital asset pricing model. However, there are some other methods that you come across, such as the shortcut, which we won't cover in here, where they say the cost of common stock is simply the sum of the cost of debt, which is the before tax cost of debt, plus the risk premium. But here we won't cover that. We will just stick to the two methods, which is the capital asset pricing model and the dividend growth model. So having an illustration of how to apply these methods, then we will look at a standard question where we have to compute everything up to the far end, which is the weighted average cost of capital. Just stay glued to the next computations. So we are going to look at the standard question, which applies all the techniques that we just looked at. The question reads, Medson Limited has the following capital structure, which the company considers to be optimal. So bonds with a before tax rate of 7%, which are selling at par, valued at $300,000. Preferred stock with a dividend of $5, valued at $240,000. Common stock is valued at $360,000. Retained earnings are valued at $300,000, bringing the total to $1,200,000. Then the additional information that we have here is that the dividends on common stock are currently at $3 per share and are required to grow at a constant rate of 6%. Market price of common stock is $40 and the preferred stock is selling at $50. Flotation cost of new issues of common stock is 10%. The interest on bonds is paid annually. The company tax rate is 40%. So in this question, we are required to calculate the cost of bonds, the cost of preferred stock, the cost of retained earnings, the cost of new common stock, and the weighted average cost of capital. So we will begin our calculations with the cost of debt or bonds. So we have to extract, in the first case, we will begin with the calculations for the cost of bonds, which is the same as debt. So in that question, we were given that bonds had a before tax cost rate of 7% in the statement of financial position and a tax rate of 40%. So that itself, it gives us the benchmark where we can start from. We apply the formula for debt, which is finding the cost of debt is equals to the before tax cost of debt 1 minus tax rate. Then our before tax has been given to be 7%, 1 minus the tax rate, which is 40%, 0.4. This gives us 7%. When we subtract here, we have 0.6. So this will give us 4.2%. So we are done with computing the cost of debt, 4.2%. Take note of this figure. We are going to use it when computing our weighted average cost of capital. So we continue with computing the cost of preferred stock, which is the required part of question B. So the most important elements that we need when computing the cost of preferred stock is dividend and its price. And we have to ask ourselves a question: was there any flotation cost on the part of preferred stock? So in that particular question, there wasn't. So only these two items are enough for us to compute the cost. So applying the formula that we looked at earlier, the cost of preferred stock is given to be the preferred dividend over its price. So this is going to be $5 over $50, giving us 10%. So that's how we find the cost of preferred stock. Again, take note of the cost here, as we will use it when finding the weighted average cost. So part C is asking us to find the cost of retained earnings. So going back to the information in that question, we only had the current dividend of $3, and then the growth, which is a constant, has been projected at 6%, and then the current market price of the common share has been given to be 40. So the point which we mentioned, saying that common stock, for internal and external, they use the same formula. Reason being, the opportunity cost of paying in dividends is just the same as what investors stand to lose in an event when the company does not declare a dividend. So that's the rationale. So looking at this information, it's clear enough that we do not have the D1, which is the expected dividend, and it's clear enough that the method that we have to use is the dividend growth model. So we have to apply the formula for the dividend growth model, which is the cost of common stock is equals to D1 over PO plus the growth rate. So we have to find our D1, which is the expected dividend. So expected dividend is equals to the current dividend then we multiply with 1 plus G, giving us $3, then 1.06. This is going to be $3.18. So that's our D1, and then now we just have to replace it in our formula, giving us the cost of common stock to be, our D1 is 3.18 over the price was $40 plus the growth rate, which was 6%, which is 0.06. When we punch in that, so we have 3.18 over 40, then we add 0.06, we have 13.95%. So the cost of common stock, in this case our internal equity, is given to be 0.1395, which is equals to 13.95%. So again, take note of this figure that we found here. We'll use it when computing the weighted average cost of capital. We proceed with finding the cost of new common stock. So when new shares are issued, there are some flotation costs which are involved, hence the difference with the cost of internal equity or retained earnings. But the formula still remains the same. We just have to make an adjustment to the price. So now, this being the case, the cost of newly issued common stock will be the D1 over the price, but we have to make an adjustment of the flotation cost, in brackets 1 minus F plus the growth rate. So the D1 still remains the same, which is 3.18 over the price is 40, then 1 minus 10%, which is giving me 0.9, plus the growth rate, which is 0.06 or 6%. Then when we calculate that, we are going to have 3.18 over 36 plus 0.06. Okay, so some calculations here. So we're going to have 3.18 divided by 36 plus 0.06. Okay, so when we punch in that, we're going to get 14.83%. So meaning the cost has gone up due to flotation cost, which is giving us 14.83%. So that being mentioned, we have calculated the cost of the individual sources of funding that are available in this question. Then the last part, which is part E, requires us to find the weighted average cost of capital. So the last part requires us to find the weighted average cost of capital. So in order for us to do that, we have to identify the source of funding, the amount, and the proportion. So referring back to the question, bonds were valued at $300,000, preferred stock were valued at $240,000, common stock were valued at $360,000, and retained earnings were valued at $300,000. So how do we find the proportions? So proportions, or the weights, we simply divide each individual amount of the source over the total. So in this case, we have $300,000 over 1,200,000. It gives us this 0.25. Similarly, we do the same, 240,000 divided by the total, we get that. And similarly to these two. having known the weights, then we have to find the weighted average cost of capital using this simple formula, which is simply the summation of the individual weights multiplied by the costs. So we go back to bonds. The weight of bond is 0.25. Then we multiply by the cost of bond, which was 4.2. Then we do the same. Then we sum everything. That will be the weighted average cost of capital. So let's just refer back to the individual costs. Let me just write them down. So what we had found earlier on was that the cost of debt after calculating, we had found 4.2%. Then the cost of preferred stock, we had found it to be 10%. Then the cost of retained earnings, we had found it to be 13.95%. Then cost of newly issued common shares was given to be 14.83 from our calculations. Then having the cost and also having the weights here, we can easily compute the weighted average cost of capital, which is the weight of bonds. So in this case, it's going to be 0.25, which is multiplying by the cost of debt, 4.2, plus, then we go to the weight of preferred stock, which is 0.2. We have 0.2 multiplied by the cost of preferred stock, which was 10%, plus we go to the weight of common stock. Common stock, in this case, we apply the newly issued one, which is 0.3. 0.3 multiplied by the cost of newly issued common stock was given to be 14.83. Then we also add the weight of retained earnings, which is 0.25, multiplied by the cost of retained earnings, which is 13.95. Then summing this up will give us, so we get 10.99, or you can simply say 11%. So what it means is if the company raises the required amount using all the 4 sources of funding that are available in those proportions, then on average it's going to cost 11% on the company. Hope you've learned something from this video. So just stay glued to the channel. For further questions, you can just post them on my YouTube channel, which is Corporate Finance with Medson Nyirenda, and then we'll discuss. Then you can also follow me on my Facebook account, which is Medson Nyirenda. Thank you for watching.